Welcome to another episode of the Chicago Business Review. I am so excited for this episode. You are going to get so much valuable information that you're gonna want to take notes for this one. So in this week's episode, we have Jose Ramirez, the founder and chief tax strategist for Advanced Tax Advisors. He is an expert in this field at implementing tax-saving strategies for business owners, landlords, and real estate investors. He's been in the accounting field for over 24 years, and he has started specializing in helping real estate investors and business owners, and now has saved them millions of dollars in tax savings. So, without further ado, I want to bring in Jose. Jose, thanks again for making the time to be on the show.
Thank you. Thank you for having me. I appreciate you inviting me here.
Oh, man, we're so excited. As we mentioned before we got on recording, I do real estate investing. I know you do real estate investing, but we're kind of in the industry. I'm a real estate broker. You're a real estate tax advisor. But for people that aren't in real estate or don't know too much about real estate, do you think it's still something that is valuable for everyone to invest in real estate, or should just the people that specialize in real estate invest in?
Right. So, I mean, there's an additional benefit to those who are already in real estate, such as brokers, landlords, people in the construction, contractors, because they may already qualify for some of the strategies that are around real estate, some of the tax saving strategies. If you already qualify for the real estate professional status, there's some hurdles that you must meet and pass. But once you meet those hurdles, the tax strategies are tremendous, right? If you don't qualify for the real estate professional status, there are still strategies for you. I always tell my clients, the majority of my clients are going to be real estate professionals. And the ones who aren't, I always tell them, you still want to get into real estate. Because if you are a business owner and you may be thinking about buying the commercial space you're in, the office space you're in, there's tax strategies around that. So you don't need to qualify for the real estate professional for some of the strategies. Now, the tax strategies are great, right? But in addition to the tax strategies, real estate is always going to appreciate over time. I've never seen real estate go down significantly over time, right? It always goes up. So all the real estate that I've amassed over the years have increased in value. So there's multiple benefits, right? You got the tax advantages, you got the appreciation of real estate, you got the cash flow component, you're making money on a monthly basis. And there's another benefit that people don't really talk about, which is the step up in basis. So when you pass on, you can transfer the real estate to your heirs, your kids, your grandkids, whoever it is, depending on the exception that there is that year. But I think right now we're at 12 million. You can transfer 12 million and not have to pay any taxes on that transfer. So your kids can get it. We're getting deep now, right? Your kids at a step up in basis. Let's say that, I'll give you an example, right? You start with a property. Let's say you bought a duplex for $500,000. You bought it in 2020. 20 years from now, 50 years from now, you're not here anymore. You still have that duplex. That duplex transfers over to your kids, and depending on what the transfer exception is that year, your kids can get it. Let's say it's valued at $5 million, from $500,000 to $5 million. Now your kids get a basis of $5 million. They can sell that property the very next day and not pay any taxes on capital gains because they get a step up in basis, right? 500,000, they get it at 5 million. There's no tax on that difference. So that's one of the benefits people don't really talk about. There's really multiple benefits to owning real estate.
That is incredible, man. You already gave so much information right there, and we're going to dive in more detail to multiple of those things because, frankly, I know I want to know. So there's got to be a lot of listeners that are investing in real estate that would like to know more detail about that. And if you do, Jose runs a free webinar that you can join. We will leave the link in the show notes. So please check it out. But it's advancedtaxadvisors.net/webinar. And you can go there, sign up, and Jose does a free webinar to educate you on real estate tax investing. And like I said, we'll have that link in the show notes. But Jose, you have been in the accounting field for almost 25 years, and then you started specializing. I know it's crazy how fast time is going, right? Even myself, I'm like, I can't believe it's been that long. But then you started specializing in real estate investing and helping investors with their tax strategies to save them money. Why the transition to specialize in real estate investing?
Oh, wow. That's kind of a long story. But in short, I have been a real estate investor since 2003. And for those of us who've been in real estate that long, you remember 2008, right? So I was, at the time in 2008, I wasn't a tax expert yet. I was a financial controller. I was financial accountant, a controller. I worked for a publicly traded company. I did SEC filings, audited financials. I managed businesses ranging from 5 million to 100 million. I talk about this in detail in my webinars. And I worked for a CPA firm in Miami for a while. And then once 2008 happened, I ended up having to get back a property to a bank, to one of the banks, right? I ended up doing a deed in lieu of foreclosure is what it's called. And when I did that, long story short, I got a 1099 from the bank. My tax advisor at the time was a generalist, didn't really specialize in real estate, so he didn't know what he was doing. He ended up telling me that I was going to owe about $68,000 in taxes. So I went and got a second opinion from a tax strategist colleague that I knew. And, first he told me to relax, breathe, right? Because you're not going to end up paying the $68,000. He was like, Jose, you lost money in this deal, so why should you be paying taxes, right? It's not reported correctly. So he explained to me the tax code. This was around 2000 because 2008 dragged for a few years, right? So this was around 2012. And once he was able to do that, he ended up getting me a refund, right? When he was able to do that, I was hooked. I was like, what did you do and how did you do it? Teach me more. What is it that I'm not looking at? And being an accountant, I've been an accountant my whole life, right? And not knowing this, I was like, okay, I'm missing a big piece of the field. I need to learn taxation. And that's when I transitioned to taxation. I got mentored by tax attorneys. 10 years later, I'm doing conferences I'm teaching people how to do these tax planning. I'm teaching other EAs, CPAs, and other professionals in the industry how to do this at conferences, right? So it's pretty cool. The journey has been amazing. The journey has been a long learning journey because taxation is not easy. Taxation is hard. But once you understand the code and you understand how to implement these strategies, the benefits are tremendous.
Yeah, and that's why I was so excited that you agreed to come on the show, because you are one of the premier experts in this field of tax strategy, which is so different than just general accounting. And so if you are investing in real estate, make sure you reach out to Jose and his team or sign up for that webinar so you get some education. But we're going to educate you here on this show as well. So you said that it's beneficial even for people that are not in real estate. But for the novice who's thinking about getting into real estate investing, or maybe somebody has already gotten into real estate investing, what do you suggest is the best way to structure the entity? Should they buy it in their own name? Should they set up a company, an LLC, an S Corp? Like, what are you recommending to your clients in terms of setting up a structure to start investing in real estate?
Yeah, no, that's a great question. So I always tell my clients, and if you guys remember nothing from this episode, remember this: you always want to separate the activities, right? So real estate can be either a passive activity by default, renting real estate is passive, or it could be non-passive, depending if you're engaged in an actual business, ordinary trader business. I'll give you an example. You are a real estate investor who flips property. You buy property or you wholesale property, you fix it up, you flip it. That is a trade or business. That is subject to self-employment tax, is not a passive activity. So you may want to do that business under an LLC tax as an S corporation, right? Because that's going to save you some taxes and self-employment tax. Now, if you are a landlord, you never want to do this activity in an S corporation for multiple reasons, right? It's a lot harder to take property in and out of the LLC once it's been converted to an S corporation. And the IRS doesn't like, S corporations to have more than 25% of their gross income come from passive activities anyway. So you don't want to be in that position for multiple reasons, because that creates tax implications. So you always want to separate the landlording, right? If you're a landlord, keep your assets under one LLC, tax as either a partnership or a sole proprietorship, depending on what the circumstances are. And then your flipping business or brokerage or construction business, whatever business that you're into, you want to have it in a separate entity away from the assets, all right? It's a way to separate the assets from the active business as well. So you got multiple reasons, tax reasons, separation reasons, it's just neater as well. I mean, there's just multiple reasons. But if you remember anything, remember this: never mix your passive activity with your active business.
Interesting. Okay, so for myself, being a real estate broker, I should not also hold my portfolio of long-term rentals in the same LLC as my operating business, you're saying?
Correct.
Okay, so keep those entities completely separate. Why?
Well, I mean, primarily, for tax reasons, right? There are two separate activities. One of them, so your rentals are going to be passive. Like I said earlier, passive versus ordinary income. So you don't want to mix the two, because if you are over here doing business with the public and something happens to that business, now your assets are exposed, right? You want to have it in a separate entity. I'm not an attorney, so I can't give you legal advice. I'm just giving you the tax perspective, right? The tax perspective is that the IRS doesn't like S corporations having more than 25% of their passive, their income coming from passive activities. When that happens, I believe it's like 3 years in a row, they can terminate your S corporation election. And if they do, it creates a headache for you, the business owner, because now you have to do liquidation of assets. And when you liquidate the assets, you're paying capital gains on all those assets that the S corporation had.
Oh my goodness.
But those are being distributed to the owner. So you don't want to put yourself in that position, right? You want to separate the passive from the active business, the ordinary income business. Now, another reason is, and this is just for you guys to know, it's a lot easier to transfer property back and forth from an LLC. There's taxes from sole proprietorship or partnership. It's a lot harder to move property back and forth from an S corporation, because when you transfer property out of an S corporation, a lot of people think, oh, but it's my S corporation. So why does it matter if I transfer it out or not? Well, it matters, right? Because now the property belongs to the S corporation. And if there's a gain on that property, the market value went up, you have to pay capital gains on that difference between your basis and the new value of that property. So that doesn't happen with the LLC, right? The S corporations have a different tax treatment.
Gotcha.
I mean, there's some technicalities there, right? There's a lot of things to consider when transferring property. That's why I always tell my clients, before you do anything, let's have a conversation, because anything that you do could potentially have the tax implication. I love that. People sometimes they just do things, and they at the end of the year they tell you what they did. Like, oh, okay, well, did you know you're going to pay taxes on that now because you did that? Yeah, it's always smart to have a conversation with your advisor before you start moving things around.
And we're going to definitely have all of Jose's contact information so you can reach out to him before you go down this path, or even if you did, try to have a conversation as soon as possible so he can advise you the best way moving forward, because he just told you separate the passive from non-passive. And that's something that I'm definitely going to do moving forward. Now, you had also touched upon what is the main difference between capital gains and ordinary income?
Yeah. So capital gains income is depending on if it's long-term or short-term. Long-term capital gains have a favorable tax rate. It could be anywhere from 0 to 23.8, 20% really, but there's an additional tax depending on your income. And ordinary income is taxed up to 37%. So it's a lot higher, right? So if you qualify for capital gains, it's always more advantageous to use the capital gains rate.
That's incredibly helpful, because I feel like a lot of people don't necessarily understand that concept. And I know we kind of went high level really early on, so I wanted to kind of bring it back, even for people that might just own a property or one investment property and they were looking to sell it. You were talking something about a basis, and you were mentioning it even in the beginning in terms of resetting that. What does that term even mean for?
Yeah, sure. So to break down basis, think of it as what you paid for the asset, right? What you paid for the asset plus any improvements that you made to the asset, any additional improvements or any additional expenses that you had for the asset before it was placed in service. So basis would be, for instance, let's go back to the example of the duplex for $500,000. You bought a duplex for $500,000 plus closing costs. Then you put into it an additional $50,000 in renovations. Now your basis is $500,000 plus your closing costs plus the $50,000 in renovations. So let's just assume the closing costs were $15,000. So you're 500, 15, 50, you're 565, right? Mm-hmm. That's your basis. Now, normally, if you are renting that duplex out, you're going to depreciate that property if it's residential over 27 and a half years. Now you have to determine how much the land value out of the 565 is. So you're going to take the land value, deduct it from the 565 because land is not depreciable. Something to keep in mind for you landlords out there, never depreciate land because it's not depreciable, right?
That's right.
So let's just say that the land value, it is valued at, $100,000. So now you're left with $465,000 in depreciable basis, right? Divide that by 27 and a half years. That's the amount that you get on the yearly basis that you can expense. It's a non-out-of-pocket expense. It's a non-cash expense that you can take on the yearly basis to offset your rental income or any other, depending if you qualify, any other income that you may have. So that's basis, right? So you track your basis because eventually, if you ever sell the property, you need to know what your basis is at the time of the sale. So if your basis is $500,000 and you sold it for $1 million, now you know you have a $500,000 basis. So you're not going to pay taxes on the first $500,000, but you will pay taxes on the difference between the basis and the sale price, right? So that's why it's important to track your basis, and that's usually tracked on your tax return, but it's not a bad idea to track it separately as well.
Okay. No, that's incredibly helpful. I feel like valuable to the listener who's just getting started. Now, what if during the time that you own that duplex that we were talking about for $500,000, and you said you put in 50 initially to get it, up to market standards.
Yep.
And then you owned it for, let's say, 10 years. And in that 10 years, you're depreciating it over, 127.5 a year. And then you invested, let's say, another $50,000 in year 5. Does your basis change, or does it stay based upon what the initial investment was?
Yeah, no, it changes because you've already reduced your basis by taking depreciation every year, right? And by the way, depreciation is not a choice. You have to take depreciation. So the IRS, when you sell the property, they're going to ask you, how much did you take in depreciation, or how much should you have taken in depreciation, because we have to recapture that depreciation. In other words, pay that back to the IRS, whatever deductions you got. So that adjusts your basis, right? The depreciation is going to reduce your basis, and you pay that back at a lower rate. So it's usually still beneficial. It's capped depending on the asset, but residential property is capped at 25%. So if over the years you've gotten a tax advantage because you were at a higher tax rate, let's say you were at 35%, at a 35% tax rate, and you depreciate it, you've gotten the benefit of depreciating and saving 35% on that depreciation. Later, you sell that property, you have to pay back that depreciation at the max of 25%. So you're still up, right? Even if you have to pay it back, you're still up 10%. So yeah, your basis gets adjusted depending on what goes on, how much money you put into the property over the years, and how much you take in depreciation.
Okay. So the depreciation, though, if you do sell it later on, they do recapture that. And so we're going to go into that a little bit further. But I wanted to kind of get that set up so that people understand that. Now, you were mentioning about benefits for real estate professionals. So can you elaborate first on what qualifies as a real estate professional with the IRS?
Yeah, so by default, real estate rentals are always going to be passive activities, right? That's according to the IRS code, section 469. There are some exceptions to the passive activity where you can make them non-passive. One of the exceptions is when you qualify for the real estate professional status. We'll talk about two. The real estate professional status is a good one. If you are in real estate more than 750 hours a year, and the majority of your personal service time is spent in real estate, right? And there are 11 categories that the IRS listed that you can qualify for, the actual industry that you can be in. I have a list right here. I'll read them to you. It's real estate property development, redevelopment, construction, reconstruction, acquisition, conversion, rental, operation, management, leasing, and brokerage. All these categories qualify for the real estate industry, right? So if you have more than 750 hours in this category, in any of these categories, and the majority of your time, 51% or more, is spent in real estate, then you qualify for the real estate professional status. What does the real estate professional status do? It removes any limitations. So it removes the limitations of having to, as long as you materially participate in the activity of the management of the properties that you're trying to depreciate. When you have a loss, normally real estate landlords are going to generate losses from the rentals, right? Because of depreciation. If you have a loss, that loss is limited to $25,000. You can only apply up to $25,000 to your ordinary income if you have ordinary income, and as long as your income is under $150,000 a year. So there's some limitations, right? If you don't qualify to take the losses and apply them towards your ordinary income, they just get suspended. They get locked in this bucket for you to use for in the future to apply the losses to other passive income you may have in the future, right? So we don't want that, right? We don't want to lock those losses. We want to use those losses. So to be able to use those losses, if you qualify for the real estate professional status with the two quantitative tests that we just mentioned, the 750 hours and the more than 50% in real estate, now you have to materially participate in the rental activity, right? Managing the property. If you meet one of the tests, now we're getting technical here, right? And I don't want to put your audience to sleep, but if you meet one of the tests, we can eliminate the $25,000 loss limitation. Any losses that you have from the rentals can be applied towards your ordinary income. So for example, if your brokerage is netting you $500,000 here a year, and you have multiple real estate properties that are netting you a negative $500,000 a year, for argument's sake, and you qualify for the strategy, you're a real estate professional and you materially participated in all the activities here for the rentals, now you net the two, there's no limitations, you net the two, how much you're paying in taxes, right?
Zero.
Exactly, $500,000 in income here and $500,000 in losses here, you net the two, you have zero income. If you qualify, you pay no taxes. So that's how powerful real estate is, right? The key thing is you have to track your time, because if somebody gets audited, you have to make sure that you can prove that you spent the time that you said you did in the material participation and as a real estate professional status. So keeping a log is going to be important. Tracking your time, with your daily activity is going to be important in an event of an audit. But you can see how powerful this is, right? Now, there is a second way to use your losses, your passive losses, and elevate them to non-passive losses, and you don't have to qualify for the real estate professional status. This is by doing short-term rentals. So if you do short-term rentals, the rule says that if your average customer stay is 7 days or less, and you materially participate in the management of the property. Now, there are 7 tests. You only have to meet one of the tests. If you meet one of the tests, you don't have to meet the real estate professional status test. You automatically qualify to elevate the losses to non-passive losses, so you can apply them towards your ordinary income. The second one is going to be, so the 7 days or less, and then there's also a 30 days or less, but then you have to have significant services, hotel-like services to qualify, and you materially participate. So there are a lot of strategies. These are just 2 strategies. There's
Yeah.
but these are all very technical, and it's on a case-by-case basis. You could be a real estate professional and not qualify for the strategy.
Really?
Oh yeah, you could, because you may not materially participate on the rental activity. So you may have enough time as a broker. You have 1,000 hours, 2,000 hours a year brokering deals, and the majority of your time is spent in real estate. But guess what? Maybe you didn't put enough time in your rentals, right? There's a 500-hour rule. There's another 100-hour rule. If you don't have enough time in your rentals, then that means that you didn't materially participate in the activity. So you have to make sure that you're tracking your time in the multiple areas of real estate to qualify for these strategies. So don't assume you automatically qualify, guys. I mean, it's that you track your time to make sure that you do.
So what about like the investors that are in the business? So they have to manage their own properties. They can't hire a property manager if they want these additional tax benefits. Is that what you're saying?
Yeah, well, they could have a manager managing the property, but the property management company cannot have more time than you. Or you have to look at it. There are 7 tests, right? 2 of the tests come to mind. One of them is you have 500 hours a year managing the property, and it doesn't matter how many people are involved. The management company can be involved, doesn't matter. As long as you meet the 500-hour rule, then you're fine. But it's hard to get 500 hours for one rental. I mean, you don't need that much time.
Yeah.
For one rental. So there's another way of doing it. You can group the activities. So let's just say that you have 10 rentals, and you say, Jose, well, there's not enough hours in the day. I can't do 500 hours a year per rental. So what we can do is group them into one activity. So now we can spend 500 hours in the 10 properties combined. And by grouping them, it makes it easier to qualify, right? The second test that comes to mind is the 100 hours and nobody else can have more time than you. So if you have 100 hours a year and materially participating, in the activity, and nobody else has more time than you, that's an easier test to meet. But the hurdle there is that you have to track other people's times. So let's just say on the example of an Airbnb or short-term rental, if you hire a housekeeper, a cleaner, you have to know how many hours she's spending a year to make sure that she doesn't have more time than you, right? So it's a little harder in that sense. It's easier to meet hours-wise, but it's harder in the sense that you have to track the time for everybody that's involved in that business.
Gotcha. Okay.
So, little nuances, a lot of technicalities, but the strategies are there. You just have to make sure you qualify.
So can somebody who is a real estate professional start qualifying for these tax benefits with their first property? Is there a way for them to qualify for that? And if so, what are the things that they would need to do activities wise to accumulate those hours?
Yeah, it would be anything relating to the management, the management of the property, right? Whether it's meeting with your contractors, or even if you're doing the work yourself. I mean, ideally, if you could do the work yourself, now you're eliminating any third parties, right?
Yeah.
Now all the time belongs to you. So it's very hard to dispute that now, because you're tracking your time that you did everything. You replaced the toilet, you painted the house, you did some repairs. So all the time is yours. Then you just have to look at the material participation tests, right? There's 7 tests, and see which one you qualify for.
Interesting. Okay. No, that's extremely valuable and helpful. So I know people are going to be listening to this one more than once, because there's so much information in this episode. And as you guys can see, Jose is a premier expert in tax strategy for real estate investors. So please sign up for that webinar or reach out to him. We're going to have his contact information here in the show notes. But I did want to touch upon depreciation. So I know there are some benefits in terms of maybe accelerating that depreciation if you are that real estate professional status.
Oh, yeah.
Can you share a little bit more upon that?
Yeah, no, I'm glad you asked that because I totally forgot to mention that. So accelerating depreciation and taking bonus depreciation is a great benefit. So the new law, the Trump's Cuts and Jobs Act back in 2017, changed bonus depreciation to 100% from 50%, right? From the end of 2017 through 2022. So 2022 was the last year that we can take 100% bonus depreciation on certain assets, qualified assets. 2023, it changed to 80%. Still good, but not as good as 100. Now, why do we want to know what qualifies for bonus depreciation? Because if we know what qualifies for bonus depreciation, now we don't have to wait the 27 and a half years to depreciate that property. We can take the whole chunk of it in the year you bought the asset or placed it in service, right? So I always talk about this in my webinar. So when you buy a duplex, the same scenario of that duplex, when you go to the closing table, all you're getting is a piece of paper called the HUD, and the HUD is telling you how much you pay for the property. It doesn't tell you what the land value is. It doesn't tell you what the kitchen cabinets value is, the appliances, the roof, the windows, the doors. You don't know any of that, right? All you know is that you bought the property for $500,000. So in order to identify the components within the property, to identify the components that are qualified for bonus depreciation, you have to do what's called a cost segregation study on the property. Now, by doing a cost segregation study on the property, you're going to get some engineers to look at your property, assign values to the kitchen cabinets, the countertops, the appliances, the roof, the windows, the doors. So each component within the property now has a value that makes up that $500,000 that you pay for the property. Okay. So now you have a list of the 5-year property, 15-year property, 27.5-year property, and any property that the IRS considers 20-year property or less qualifies for bonus depreciation. So again, I'm getting technical, but 20 years or less is bonus depreciation. So let's say that the $500,000 property, we were able to identify $100,000 in 20-year or less property, which qualifies for bonus depreciation. Well, guess what? Now you can take that bonus depreciation, the year that you placed that property in service. So now you automatically have $100,000 of a deduction the first year, which can be used if you qualify. If you qualify for the strategy, it can be used towards your brokerage income or your other real estate income, your flipping income, your wholesaling income, right? So very powerful, right? And it's very easy to do. All you have to do is keep buying property every year, keep buying real estate. That's why real estate is so powerful. I mean, a lot of landlords pay very little tax or no tax at all because what do? They know that real estate appreciates over time. They know that real estate is going to give them a tax advantage. So instead of overpaying in taxes every year, they're just taking that money and buying more property, right? So when I meet with my clients, usually around tax planning season is around October, November, December at latest. And we have a conversation, right? The conversation will go like this. All right, Joe, so you're going to owe an additional $70,000 in taxes. Would you rather take that $70,000 and pay the IRS, or would you want to take that $70,000 and buy another duplex, fourplex, sixplex, whatever the case is, put it as a down payment, so we can reduce that $70,000 to maybe $20,000? I don't know. I'm just making up numbers. Right?
Yeah.
But guess what the answer is always going to be? Yeah, let's. I'm going to find a duplex before the year ends, and I'm going to place it in service. Right?
Yeah.
I'm going to do a cost segregation, depreciate the crap out of it, and reduce my tax liability. So that's kind of the game, right? Real estate is very powerful. It's one of my favorite industries because of that reason. You can kind of control your taxes by planning. You can always plan, hey, I had a pretty good year this year. I'm going to have a big tax bill. Why don't I buy some buildings? Put a down payment on buildings. And you can leverage this, right? You don't need to have $1 million to buy a building. You just need, 10, 20%, right? And
Yeah.
the rest comes from a bank,
Th-
but you still get the tax benefit from it.
That's incredible.
Yeah.
And yes, I knew this, but I think there's so many people out there that are not aware of this. But again, we want to clarify that is for people that have real estate professional status, correct, Jose?
Yeah, for this strategy, it would be real estate professional or short-term rentals.
Okay. Oh, yes. Or short-term rentals, which is another great strategy that you can implement if you are not a full-time real estate professional.
Yeah.
So the cost segregation study, I hope people remember that. The bonus depreciation is such a powerful tool. I know some people are going to ask, so what happens like if you showed income and therefore you owed $100,000, but then you were able to use that depreciation to wipe out that 100,000? Does that then take away from your documented income? And will that impact your ability to purchase the next property? How does that work?
Yeah, that's a very common concern. I mean, that's really a banking question, but my understanding is that when it's happened to me, I know that most lenders will add back the depreciation because they understand that it's not a real expense, right? Depends on the bank. I mean, yeah, depends on the bank. But yeah, I don't think it's that big of a deal to worry about.
Yeah, great. No, because I'm sure people are like, well, if I write all of that off, now I'm going to show that I have no income, and how am I going to buy the next property?
Yeah.
So you were talking about the depreciation. If you do take that depreciation, it affects the basis of that property. So if you sell that property and you don't reinvest it into another asset through a 1031 exchange, you then pay taxes on the new basis with the depreciation already having been taken out. Now, if you do not sell that property ever, and then you pass that down, that basis resets to whatever the current value is.
Oh, yeah. I love where you're going with this. Yeah, this is great. So if you never sell, which is the ideal situation for any real estate investor, the idea is to accumulate as much real estate as you can, amass as much real estate as you can over your lifetime. Never sell it because it appreciates, right? Real estate appreciates. If you need money, you can just get a loan on it. There's no tax on loans. You're not paying taxes when you get a loan, right? So it appreciates over time, and you're collecting all this money because eventually you're going to pay off the property. There's not going to be a mortgage on it. So all that cash flow is just going to you directly. If you sell it, you pay capital gains on it. If you keep it forever and your heirs get it, your kids get it, your grandkids get it, there's going to be that step up in basis, right? Now, when we started, we mentioned a little bit about the exception being 12 million.
Yeah.
It seems like it changes with every president. So it is 12 million now. It could be different in the future. But what that means is that you can transfer assets when you pass on. You can gift assets when you pass on, or, just transfer them through your estate and not pay any taxes on the transfer for up to 12 million change, right?
Yeah.
So if you've amassed, let's say, I don't know, $5 million, you bought $5 million in assets over your life, which is a small number, right? I mean, you want to do more.
Yeah.
And that number, when you pass on, is at 12 million. It's the value has appreciated and it's at 12 million. You can transfer that property to your kids and not pay taxes on the transfer, and your kids will get it at a $12 million basis. Now, think about that for a second. They'll get it at 12 million, which means they can sell it the very next day for 12 million and not pay a penny in taxes, because that is their basis. Their basis is 12 million now.
Yeah.
And the difference between the 5 million and the 12 million in this example, I'm sure over the life of the individual, they've depreciated the asset.
Pretty much all those assets.
Pretty much all of it, right? And he doesn't have to pay that back. He or she will not have to pay that depreciation back, because
that is
depreciation dies with the person.
That's so incredible. So now, oh my goodness, there was so much great information right there. And so that's kind of where I was hoping that was going to go is, again, you don't pay taxes on that hypothetical $7 million appreciation by holding on to that real estate and passing it down to your heirs. And now they don't have that tax burden. And of course, that number changes. Like Jose was saying, with every president, that kind of changes. But for right now, that's the number. And so that's a huge benefit. Another thing that you mentioned upon in that I wanted to point out was the loans or taking money against the asset, because that is not income. So you do not pay taxes on taking out money. And that's how so many of my investor clients that I work with play this game. And so it's so important for you to know people like Jose that can guide you through these steps, because we're not talking about small money here. We are talking about large amounts of money that you can save and keep in your own pocket so you can continually play this game of growing that portfolio.
There's so much you can do. I mean, in terms of tax planning, I mean, you want to get your family involved in your business. You want to get your kids involved in the business, because now you can pay them for helping you out, cleaning the property, cutting the grass, things like that. And now you're paying them at a lower tax bracket, right? So if you're in a 35% tax bracket and you're paying them up to I forget what it changes every year, $12,000
around
the first $12,000 you don't pay taxes on. So you're kind of like shifting your money to your kids where they don't pay taxes, and then you get a deduction on your side. So there's so much you can do in terms of planning when you have a business, when you're in real estate. Another one is, buying real estate under your self-directed Roth IRA. That is a popular one lately. I mean, a lot of my clients are doing it. I have a self-directed Roth IRA. I lend money out of it to some of my clients, or, that sort of thing. It's where you buy real estate, and when you sell the real estate, the profits that you get from the real estate are not taxable. There's some exceptions, right? I mean, if there's a loan involved, there's some exceptions there. But, if you lend money out of your Roth IRA, let's say that you're getting 15% back, that interest that you're getting back into your Roth IRA is not taxable. So that's a good way to grow your retirement fund tax-free. Self-directed Roth IRA. Instead of investing your money in the stock market, Wall Street, which you don't know which way it's going to go, which year, right? Now you're investing in something Let's say real estate. Invest in real estate in your self-directed IRA. I had a conversation with a buddy of mine, Mark Kohler, recently, and we were talking about investing in cattle, right? We're into ranching, and you can buy cattle in your Roth IRA and make money, grow your IRA that way. You can invest in anything you want. I mean, anything that you understand. If you're in the business that you understand, you can invest in that. So there's so many ways that you can save money in taxes and grow your portfolio, and get your family involved so that you can get your kids involved, so they start understanding the value of business and the value of saving money in taxes. It's such a wonderful thing.
That is amazing. So in that example with the children, do they have to then be employees of the company, or do you 1099 them? How would you recommend somebody trying to take advantage?
Depending on the entity that you're using. So if it's a sole proprietorship, it would be a W-2. And because if the children are under 18, there is no taxes that have to be withheld, no Social Security, no Medicare. If it's an S corporation, it's a little different. You do it through W-2 payroll again, but the Social Security, Medicare do have to be withheld. So it's a little different.
Gotcha.
But still beneficial.
Yeah.
The business experience of having your kids learning the business is the benefit in itself. The tax benefit is just a gravy.
Right? Yeah. No, that's what I've been trying to educate my kids on, is this is the best way to generate long-term wealth, is by getting into real estate investing. And that's why I did a solo podcast episode on the 3 benefits of investing in real estate. And I didn't even mention the tax advantages. So I'm so glad you're here to really set the record straight in terms of all of these benefits. Man, I cannot believe how quickly this time is going. I feel like I could ask you another 3 hours worth of questions, but I wanted to get back to So some of the people that I work with, one of them might be a full-time like flipper or wholesaler, and they want to partner up with somebody who has a career, but maybe they're providing the financing for the transactions or things like that. How would you recommend they set up an entity to protect, I guess, both parties, but also still try to maximize their tax savings?
Yeah, great question. I mean, I think that's going to depend on the relationship, right? How close the individuals are. I mean, they could do a partnership. One of them could be a silent partner. Or instead of doing a partnership, the person who has a career and not in real estate, because real estate is a career, right? So somebody else in another career that's just putting the money in, they can do it as a loan. They can have a loan agreement and they would agree on a percentage that he would get back as interest. So multiple ways of doing it. It's just a matter of what feels right for that relationship.
Interesting. Okay. No, and then do you have any thoughts or suggestions on setting up any type of trust to hold the properties in, or is setting up an LLC?
Yeah, I mean, I could tell you, as I said earlier, I can't give you legal advice, but
I
can tell you what I do. So I have a trust. I have a revocable trust that owns everything I own, right? Now, I also own real estate under LLCs. So my LLCs own my real estate, my PA owns my firm, and my trust owns everything. So my name is removed from everything. So if you were to look up, Jose Ramirez real estate assets, you wouldn't find anything because my name is not on anything, which is a great way to keep yourself anonymous. It doesn't give you, my understanding is that it doesn't give you any asset protection. It just gives you, the trust is just really for estate planning purposes. It gives you a clean, something happens to you, God forbid, it gives your family a clean guide on what's going to happen with the assets. How are they going to get it? How they're going to be distributed, so you don't have to go to probate court on it. Now, another strategy that I use, I like Wyoming LLCs. I use Wyoming's as a holding company. Now, my Wyoming LLC owns multiple LLCs in multiple states where my real estate is, right? So that kind of gives me the true anonymity because Wyoming doesn't report who owns the entity publicly, right? There's no public information there. So that's nice, right? It gives you nice anonymity. The LLC, for instance, my LLC in North Carolina is owned by my Wyoming LLC, which nobody knows who owns. So it's completely, anonymous. It's nice.
No,
that's a strategy that I use. Some of my clients use it as well, but I like that strategy. And definitely the trust, it's a must have if you have children, in my opinion. If you have life insurance, in my opinion, you should have a trust involved.
No, that's incredibly helpful. And yes, we are not legal advisors, but we're just giving recommendations based upon our experiences and what we do. But please consult a legal professional before setting up any of these entities. But we know for sure what Jose does, which is he is a tax strategist for real estate investors and one of the top in the nation. So please, guys, sign up for that free webinar. He's giving such great advice and information to you free of charge. And you can always reach out to him as well to get connected and get more information so that he can save you money and set you up so that in the future, you're in the best position to capitalize and not be giving away that money. So, Jose, I can't thank you enough for your time and for all of the information that you've given. For the listeners, what is something that maybe you get as a question from your clients or something that you hear frequently that I might not have asked that you think is valuable advice or information?
No, that's a great question. I mean, a lot of the questions that I get, actually, you touched on is,
good.
How should I structure my business? I mean, should I do an LLC for this? Should I do an S corporation for that? So that's a big one that gets asked a lot. So
Yeah.
understanding that you want to separate the passive from the non-passive, it's going to be huge. Separate the activities, separate entities for those. One may be an S corporation. The other one is definitely going to be a sole proprietorship or a partnership if it's a passive activity, if it's holding assets. So that's
Yeah.
that's
No, that would,
if you guys want to get connected, I mean, I do tax tips on a regular basis on social media. They can find me at Chief Tax Strategist on Instagram. I do stories and videos. I mean, you've seen the videos. It's
yes.
short, the 1 minute videos on tax strategies. And join my webinar.
Yeah. Join his webinar. He's on LinkedIn. He's on social media. Chief Tax Strategist is where you'll find Jose. So, Jose, you shared with us about how to set up an entity, passive versus non-passive, depreciation benefits, tax benefits, how to organize doing even working around that real estate professional status with short-term rentals, bonus depreciation. There was so much information in this episode. So, guys and girls, if you found value in this, please leave a comment. Provide your feedback, reach out to Jose and thank him for his time. He doesn't have to do this, but he wants to provide the investors with more information so you can avoid the situation that he was initially in and so many people were in because they just don't know any better. So reach out to Jose. His links for social media and that webinar are down below. Make sure you sign up for that. And please give him a follow. He provides great content on a regular basis that most people would charge for, and he's giving it out for free. So follow Jose, and please, if you liked this episode, you found value in it, share it with somebody you know. This is definitely going to help them save thousands, if not more, in taxes. So I hope you guys found value in this. For myself, Young Lee, Jose, thank you so much for being on the show. And everybody, thank you for listening. Please leave a comment, a review. That's what helps us get amazing guests like Jose on the show to provide this value. So until next time, guys, thank you so much for listening and watching. We'll catch you on the next episode.